Assalamualaikum warahmatullahi wabarakatuh. My name is Faizan Najah. My metric number is 307019. Today I will be presenting my study on press metal aluminium berhad in Malaysia. So this study is focusing on its performance and determinants. Especially, I examine how internal and external factor influence the company return on asset. The issue and problem. The main problem is that press metal face significant operational risks, particularly environmental concern. In 2020, they were compounded with 40k ringgit Malaysia for order pollution and open burning at their Muka plant. So these environmental issues can damage investor confidence and affect profitability. Additionally, as a multinational corporation, they face external risks like volatile aluminium price, energy cost, and exchange rate fluctuation. So I'm going to continue with the research objective. So my 5 research objectives are: first is to analyze the impact of liquidity ratio on ROA. Second is to examine the effect of efficiency indicator on performance. Third is to determine the influence of leverage on ROA. Fourth is to investigate macroeconomic variable role in shaping performance, and last but not least is to find which factor have the most significant relationship with ROA from 2050 until 2024. These are some research questions. First of all is, how do liquidity ratio affect return on asset? What is the impact of efficiency indicator? Does the debt to income ratio influence ROA? How do GDP, inflation, interest rate, and exchange rates affect performance? And last but not least, which internal or external factor has the strongest relationship with ROA? In this study, I use ROA as the key performance indicator. So ROA indicate how efficiently a company generate profit from its total asset. An increase in ROA show a corporation is becoming more profitable. Company that efficiently utilize asset to generate return are seen as well managed and command higher market value. So for internal factor, use current ratio, quick ratio, average collecting period, debt to income ratio, operational margin, and last, corporate governance index. For external factor, I examine using GDP, inflation, exchange rate, and unemployment rate. For methodology, I use sample and data. For this study, I use data from Press Metal Aluminium Holding Berhad's annual report spanning 10 years from 2050 to 2024, giving us 10 observations. So for the analysis method, I employ ordinary least squares, which is OLS regression, using multiple linear regression analysis through IBM SPSS version 26. This approach, as described by Moore 2006, is used to study relationship between one dependent variable to several independent variable. So, and also I use 3 model tested. I tested 3 distinct regression model. First of all, model 1 is internal factor only, model 2 external factor only, and model 3 combine internal and external. So this model examine all variable together to determine their collective on ROA. The data was extracted from annual report and official database. Then analyzed using SPSS for descriptive statistic, correlation analysis, regression analysis, and model summary evaluation. Statistic based on model 3, the mean ROA from press metal over 10 years period was approximately 17%, indicating strong asset utilization. However, the standard deviation of 47% show high volatility in profitability. The current ratio averaged 252%, indicating strong liquidity, but the quick ratio average is 1,500%, which is unusual and suggests extremely high liquidity risk. So the average collection period is average 400 days, which is excessively long and indicate difficulty in collecting receivable. The debt to income ratio average 600%, representing extremely high leverage. So for last is microeconomic variable, which is GDP average 4%, which high volatility. Inflation average 1.78%, and the exchange rate average is RM 4.28 per USD. So for the correlation, the significant correlation is operating margin that have positive correlation. So the higher margin, higher ROE. So not significant is current ratio, high but volatile, range from 0.68 to 9. For model summary finding, model 1, which is internal, R square is positive but adjusted R square is negative, so indicating very poor explanatory power. For model 2, external, which is R square is positive but external R square is negative, also very poor. For model 3, combined external and internal, which is the R square is positive and also adjusted R square also positive. So this clearly shows that model 3 is the most powerful, explaining nearly all variation in ROA. Internal or external factor alone is insufficient. The combination of both provide the strongest explanation. When analyzing variable individually, none were significant. However, in a combined model, debt to income ratio show a positive coefficient, significant at 10% level. Interest rate show a positive coefficient too, also significant at 10% level. This means higher leverage and higher interest rate are associated with increased ROA. The positive relationship with interest rate might seem counterintuitive, but in the context of price method, it could reflect company ability to pass on costs or benefit from economic condition. The FIF value for all variable were below 10, indicating no severe multi-collinearity. So for the conclusion, both internal and external factor matters. Neither alone is enough. So second is company face high risk with this analysis, such as liquidity problem, credit problem, and leverage problem. And ROA fluctuated greatly from 40% to 0.011%. And also, corporate governance is improving with good trend. And for the recommendation, first of all, is stricter credit policy and efficiency collection. Reduce debt and issue more equity, maintain more liquid asset, reduce costs, invest in technology, continue improving practice for corporate governance, and also last but not least, form a risk committee and cross-functional approach.